Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you again for joining us, where we're going to cover a few of the topics from this week's investment allocation meeting. We're going to start off, we're going to talk about personal consumption expenditures. We're going to hit valuation, something we don't hit frequently because there's not a whole lot of change, but we're going to hit it this week. Small caps approaching a critical level technically, and then take a look at home builders. So we're actually going to tee it off here with personal consumption expenditures. This is a key data series that affects the Federal Reserve's outlook, particularly included in there as a measure of inflation that they prefer. But inside there is a way to measure how households are spending their funds. If I draw your attention to the black line, that's the overall expenditures for the United States. And you can see we recovered finally our 2019 or our pre-2019 trend level. Of course, we fell off a cliff, but slowly but surely grew rapidly enough, especially last year, to reapproach that trend. But underneath it, it was far from an even way to get there. This is a story you know well by now, but this is a great picture to it. The blue and the orange line represents durable goods, those that are expected to last 3 years or longer. Think appliances, stuff like that. And then non-durable goods. Both of those vastly outperformed services. Of course, the economy came back much slower for services, but we see there's really a rotation going on underneath that. You saw that actually in the middle of this week with Walmart's earnings, a continued glut of inventory as retailers, nearly every one of them projected this trend that we would stay this strong. And so now they're dealing with an uneven amount of inventory that they've got to figure out how to get prices cut. So one thing that we've always reminded people of is that inflation is always a very personal measure. We have to come up with one average that we reference across the nation, but each of you have a different bundle of inflation. And so whether you're goods heavy or services heavy, certainly will be impacted by that. But we do look for services to continue to play a bigger role, and that has implications for the portfolio. We look at things particularly like travel and a strong backlog of medical checkups and regular routine things that got pushed to the side in the COVID era. So that's personal consumption expenditures. Moving out to valuations. I've got three things up here in the chart. So the reason for sharing it, this is things we hit periodically. We had a fall off in the market, then in a strong rebound. It's at a good point to really check in and see where we are. The three lines here are the three S&P measures. You got 500, which are the large cap. Those are the ones we spend the vast amount of our time on. But the smaller and mid cap are on there because they're important too. So the red line is that S&P 500. Last year, 2020 and 2021, really was an era where the valuations got really ahead of themselves. They got strong into levels that we really hadn't seen since the dot-com era, one that it took 10 years to actually get rid of the excess valuation and move to lower levels. So we have fallen down there. And even though the markets have recovered strongly, we still are what we would call just an average, nearly 18 multiple for the 500. Meanwhile, and this is really probably the most important point on here, small and mid caps still carry a very, very inexpensive level, something that we've really only seen back in the great financial crisis of 2008 and very briefly in the COVID crash. So something that you don't see that often, because usually small and mid caps command a stronger price tag. You will pay more for them because they're smaller, they're on the way up, and they're growing. But now not only are they less expensive, they're a lot less expensive. So this isn't something that will correct itself overnight. It's not something we have to jump in and chase each and every quarter. But as we progress through the next several years, I believe that represents an opportunity that we have to stay, keep our attention on. So speaking of small caps, Andrew, it's time to check in on where they're at in terms of technicals, because this gives us the prior chart and valuation gives us a sense on what we need to be looking at, what we need to be focusing on, not necessarily when or how. That's where you step in with your technicals. So small caps, please.
Yes. So just like large caps, which we often talk about in the market curve, when we talk about the S&P 500, we never want to forget about those smaller assets as well, just as Adam was talking about with valuations. When we look at the chart for two different indices, of small caps, we have the S&P 600 and we have the Russell 2000. They both are a grouping of small cap stocks. We like to look at both of them just to see if they're kind of telling the same story, and today they are. What we see here is a chart going back roughly the last little over a year. You can see there at the bottom of the chart goes back to 2001. And we saw coming into 2022 that small caps, actually on both charts, were testing some support. You see the green arrows there as the price is coming down to test that blue line. Then we saw a bounce higher on the S&P 600. It tested that 200-day moving average, that kind of curved line. And that acted as resistance. And that was telling us there was more sellers than buyers. Were a little bit stronger. The sellers were a little bit stronger. And that level, that really key 200-day average, acted as resistance. And that's what kind of kicked off 2022 as prices started to come back down. Now we've seen the rebound over the last couple of weeks, and now we're seeing both S&P 600 and the Russell 2000, both are testing that 200-day moving average once again. And we're actually seeing this across many indices. The S&P 500, again, we'll record this video on Tuesdays, and we're getting a test now for the large caps as well of the 200-day moving average. This is a very key, very heavily watched price level, and so there's going to be a lot of focus and a lot of attention from the trader community and from asset managers to see, do we start getting prices back above the 200-day. The reason it's so important is historically there's an old saying for technicians that goes, only bad things happen below the 200-day moving average. Typically downtrends are defined by price being under this long-term average. And so that's why we see a lot more volatility, a lot more whipsaws. We see a little bit more bearish activity when price is below this long-term average. So we start seeing a lot of these indices, small caps, mid caps, large caps, if they start to break back above this key area, it tells us that maybe that we really do have buyers are in a lot more control, and that we're starting to get maybe the start of a new uptrend. Now, nothing's promised, of course, but this is one step at a time, but we're starting to get a lot of tests of that 200-day. It's a positive sign. Hopefully we see a break above, and we can start getting a little bit more firm belief that bulls have started to retake over this trend. But it's the way the evidence is on that test. So we're getting it now across the board. We'll see how we finish out the week.
Yeah, sir. It's an important juncture for sure. And we use that here and there, but this is absolutely one of those critical juncture across the board. Moving now, we're going to end on some housing data. Once upon a time, it seems like housing wasn't constantly in front of us as more of a steady business. But ever since 2008, it's an industry that has been just kind of all over the board, particularly the last couple of years. And you shared this with us on Monday as a really surprising turn in a sector that was just red hot a year ago. So if you'd share your thoughts on the NAHB Index, that would be wonderful.
Yeah, that Adam's exactly right. Housing had been very strong kind of during the COVID period last year. We're seeing record sales across the country. Housing prices were going up. It was just a very bullish, a very positive time for the housing market. There's a lot of people that were moving out of some of the bigger cities, wanting to go to the suburbs as people were starting to work more from home. Just the whole economy was starting to change after that COVID period. And we saw the housing market, again, was very, very strong. Then we started having a lot of the commodity prices started to go higher. Lumber got more expensive, steel got more expensive, and then the Fed started to raise interest rates. When interest rates go up, what also goes up is mortgage rates. And as mortgage rates start going higher, even if though that they were still historically still very low compared to what they had been back in like the 70s and 80s, they started to go higher than where they had been. And that started to deter some buyers from maybe making that purchase. They realized that their housing payments were going to be going up a couple hundred, possibly a couple $1,000s a month as interest rates started to tick higher, began to start putting the brakes on the housing market. So the latest data we got was from, again, the National Association of Home Builders. It's their housing market index. And the way to read this chart is very simple. It's when it's above 50, that means it's expanding. It means the housing market, according to this gauge, is expanding, seeing growth. That's a good thing. When this gauge falls below 50, it's telling us that the housing market's seeing a contraction, that the growth is slowing, prices actually are starting to go lower. And the big surprise was when we got the latest data for July, we went from a 55, which was a positive growing figure, and that's what economists were expecting again for July. It actually fell to a 49, fell below 50. And outside of the COVID crash, the last time we really saw a drop below 50 was during the financial crisis after the housing bubble from the 2000s. So it's been quite a while since we've seen a move into a contraction period for the housing market. And this is, again, very attributable to the rise in interest rates. And so we'll see going forward, do we see kind of a knock-on effect of a lot of the other industries, a lot of the commodity prices, do they start coming back down? We have seen lumber prices come back down, so that should be a positive. But we'll be getting a lot more housing data this week. The number of housings that are starting to be built. We get some more mortgage data and really start to dig into what's going on in the housing market. The reason this is important is, again, shelter is a part of that inflation data. Adam was talking about the PCE earlier. We're talking about the inflation rise, and it started to maybe slow a little bit. We've talked about this in the market curve in the past, but shelter is a part of that. So if we start seeing shelter prices come down, then that should start pulling down some of that other inflation data as well. So there's a lot of different things that connect to the housing market. We're not really used to seeing a contraction in housing prices, but that's what we're seeing right now, at least so far. We'll see if that trend continues. But the rise in interest rates having a negative impact right now in the housing market as makes it a little bit less attractive to buy a house with these higher rates, even though rates are still, again, historically very low.
Yeah, absolutely. But it's probably hard to find something with such a big change in such a short period of time. That just,
right.
It's kind of like me when I leave McDonald's. It takes a long time to digest that overconsumption there, that big change to my digestive tract. But thank you all again for joining us this week. Don't forget to come in and see us if you haven't seen us for a while. 800-928-4001 is the phone number, where you can scan the QR code and we'll link up and get you scheduled digitally. And then lastly, don't forget our radio show, which airs over the airwaves each and every Saturday morning on WIBC, as well as a few other select stations. Or for most of you, it's more convenient through podcasts, however you get yours. Thanks again and have a great weekend.